ordinary bank would have suffered. The place would have been broke. So we were basically betting that their real estate lending was way better than average. And indeed, it was. And they also handled it on the way down way better than average. So you can argue that everybody else was looking at this horrible concentration of real estate loans and this sea of troubles in the real estate field and in bankers to the real estate field, and they just assumed that Wells Fargo was going to go broke. And we figured, no, that since their loans were way higher quality and their loan collection methods were way higher quality than others, that it would be all right. And so it worked out.
Probably couldn't have told that. If we hadn't gone a little further, though, than just looking at numbers, we would not have been able to make that decision. Zone 1.
David Carr, Durham, North Carolina. Tam Brands and U.S. Tobacco are two companies which are primarily single-focused product companies that seem to possibly have some barriers to growth in unit sales and pricing, and have employed a strategy of returning cash to shareholders through stock repurchases. Both companies have, at times when they thought the stock was at a discount to intrinsic value, used debt to accentuate their repurchases. Those companies recently have talked about problems with going into a negative stated shareholders' equity position through the use of additional debt to repurchase more shares at a time when both companies believe their stock's very cheap, and they appear to have the type of long-term cash flow that would at least allow that. Would you comment on the at least accounting treatment and the stated shareholders' equity, and if you think that should be a real concern for management in those areas?
What was the first company besides U.S. Tobacco?
Tam Brands.
Tam Brands?
Yes.
Yeah, I don't think there's anything magic about whether shareholder equity is positive or negative. The Coca-Cola has a shareholder equity of $5 billion. It has a market value of 75 billion or so. Now, they're not going to do it, and I'm not going to recommend it, but if they were to spend $10 billion buying in their stock, they would have a negative shareholders equity of $5 billion. Their credit would be sound. I mean, if somebody else were to buy the company for $75 billion, they'd have $5 billion of tangible assets and $70 billion of intangible assets. And there is nothing magic about a company having a positive shareholders equity, and it isn't done very often, and I can't even think of a case where it's been done, but it may have been. But I see nothing wrong with a company having a negative shareholders equity, although it may be prohibited by the state in which they're incorporated in terms of repurchasing shares at a time that would produce that. You have to look at the state law on that. But any time a company in an LBO or something is bought out at some very large number over book value, in effect they're creating a negative, if they borrow enough money on it, they're creating a negative shareholders equity in terms of the previous shareholders equity. It's just a fiction as to the numbers between the two organizations. Now, you should buy in your stock when you don't have a use for the money, and that could be management specific. I mean, some managements might have a use for the money if their field of capital allocation were large enough, whereas another management that was more specialized in their own business might not. But once a company has attended to the things that are required or advantageous for the present business, we think reacquisition of stock is a very logical thing to consider, as long as you don't think you're paying more than the intrinsic value of the business in doing it. And obviously, the bigger the discount from intrinsic value, the more compelling that particular use of money is. Charlie?
I've got nothing to add. Generally speaking, maybe Coca-Cola can have a negative equity, but I don't think it would be a good idea for General Motors. I think there's something to be said for a positive shareholders' equity.
Zone 3.
Edward Barr, Lexington, Kentucky. I had a twofold question. Number one, you mentioned American Express earlier, and I was curious as to whether the fact that credit card usage is only 10% of all transactions and that may continue to grow for some time going forward was a factor in your decision. And the other part of the question pertains to the durability and permanence of the banking franchise with regard to alternative delivery channels that may appear over the next few years, including the possibility of the Microsoft Intuit merger.
Well, the specific number you mentioned about credit card usage and so on, that's not a big factor with us. We think credit cards are both here to stay and likely to grow to some extent, although at some point you start reaching limits, at least in terms of outstandings that people are that make any sense. But the credit card field is a very big field. The question is who's got the edge in it, because everybody is going to want to be in it, and they already are, and there are a lot of different ways you can play the game if you're in the credit card business, and you better have some way of playing one part of the game, preferably a large part, but you better have some way of playing one part of the game better than others, or natural capitalistic forces are going to grind you down. I mean, it's a business that people are willing to change their minds about what they do in. I mean, if you offer somebody a credit card that gives them some advantages that don't exist on their earlier card, people are quite willing to shift cards. So you need some kind of an edge in some particular segment of the market. So the growth aspects overall of the market were not a big factor with us. It's really a question of figuring out who's going to win what game and who's going to lose what game. And what was the second question again on that?
The second question pertained to the permanence and durability of the banking franchise.
Oh, yeah, sure.
And whether alternative delivery channels over the next few years may erode the durability of that, including the Microsoft Intuit merger.
Well, that's a good question. You're certainly seeing the value of bank branches diminish significantly. It used to be a point of enormous pride with managements, how many branches they had, and it was, often political influence and everything else was called into to obtaining branch permits. And the world will change in banking probably in some very major ways over a 20 or 30-year period. Exactly what players will benefit and which ones will be hurt, is a very tough question. But I would expect. I don't think I'd expect really significant change in banking over the next 5 years, but I'd certainly expect it over the next 20 years. And there are a lot of people that have their eye on that market, including Microsoft, as you mentioned. It may be to their advantage to hook up with the present players. I mean, I know it's certainly something that gets explored, but they may figure out a way to go around the present players too. And that's one investment consideration. Charlie?
Yeah, the interesting player that went around the rest was Merrill Lynch. Merrill Lynch went heavily into banking with its cash management accounts. And I don't think it's the only innovation that'll come along.
What's the name of that book?
I've forgotten. That's a marvelous book.
There's a great
Maybe
book.
Molly remembers. What was that book you gave me? It was the history of the credit card.
Was it Joe Nocera's or? Yeah, Joe Nocera was the author. I don't remember the title, but came out about 6 months to a year ago. It's a terrific history of the credit card business. And if you read that, you will get some idea of the amount of change that can occur in something like the movement of money. And my guess is that if there's another edition of it in 20 years, there'll be plenty more to write about. So,
by the way, that is a fabulous book. Most of the people that were here will not be able to put it down. I mean, for a book about an economic development, it captures the human background in a very interesting way.
Is it Zone 4? That seems far over there for Zone 3. Yeah.
I was Adam Engel from Boulder, Colorado. I was wondering if you could comment on the moat you see around the castles of SunTrust and PNC.
Well, I don't think I should comment on anything on specific holdings like that, but so I would say you would look at those in a general way very much as you'd look at banking operations first, and then you try and figure out what are the specific strengths or weaknesses of both organizations. But there again, I don't want to spoil the fun for you. Charlie?
Nothing to add.
Zone 5.
My name is Bob McClure. I'm from the States, but I live in Singapore. About a week ago in the Asian Wall Street Journal, a remark was attributed to Mr. Munger, specifically that owning Salomon Brothers was like owning a casino with a restaurant in the front. The casino alluding to the proprietary trading and the restaurant to the so-called client-driven business. If that attribution is correct or accurate, can you
Well, I don't
elaborate on why you view the business in that way?
I don't think it's entirely correct, but I have a pithy way of speaking on occasion. And I frequently speak in a way that works with an in-group but wouldn't necessarily work everywhere else. And every once in a while, when you take one of those wise-ass comments out of context, why, I very much wish that it hadn't occurred. This was such a case.
It won't stop him in the future, though. Or me. Zone 6. Are we in 5? Which one are we in? Kelly or?
Mr. Buffett, I'm Randall Bellows from Chicago, and the two questions I have, since you're answering questions so far afield, are if you were to look at the balance sheet of the United States of America, is the national debt as frightening as that it appears to be? And secondly, in terms of redeployment of capital, if Coca-Cola is such a wonderful investment, has returned so much, why not redeploy some capital in purchasing additional shares of Coca-Cola? And finally, thank you for letting Jane do that portrait of you, and if it's good, we'll do Mr. Munger next. Thank you.
First question about the U.S. balance sheet. The net national debt is about, it would be about 60-odd% of GDP.
Without counting unfunded pensions.
Yeah, but also with a claim on the income, in effect, of future citizens, which also was an asset too that you could set up. But that figure, I think, at the end of World War II, may have been. I know it was around at least 125%, may have been 150% or so of GDP. So we have sustained. Now, the interest rate on that debt was much lower. A lot of it was at 2.9% because that's what savings bonds paid. But that level of debt, which I don't advocate in relation to GDP, turned out to be quite sustainable. And as a matter of fact, it drifted down year after year for a long time until the early 80s when it started rising again. And now it's actually fallen a little bit in the last the ratio of debt to GDP. There are a lot of measurements of how much debt is too much and all of that. But probably, I think that if I had to look at one single statistic, I would look at that ratio of just like I would look at a ratio of debt to income for an individual. Then you'd get into the question of the stability of the income and to whom it is owed. But I do not think that the level of debt relative to the economy is of anything that's of a frightening nature. I like the idea of it trending downward a little bit over time rather than trending upward. And if it keeps trending upward, it can get awkward, although I think in Italy it's close to 150% now. And you start getting to 150% and talk 8% interest rates, and you're talking 12% of GDP essentially going to interest. If you were to put a balance sheet of the country together, it's kind of interesting because you would have this $4 billion of net debt on the liability side, and you'd also have a lot of pension obligations, as Charlie mentions, on the liability side. But you got a lot of assets too. You've got a 35% profits interest in all the American corporations. I mean, the government, if it has a 35% tax rate, really owns 35% of the stock of American business. They own a significant part of Berkshire Hathaway. We write them a check every year. We don't write you a check every year, but we write them a check. We plow your earnings back to create more value for their stock, in other words, the taxes they get.
You're trying to cheer these people up.
But what would you pay to have the right today to receive all the future corporate tax payments made by all the companies in the United States, the discounted value of it? You'd pay a very big number. What would you pay to have a right to take a percentage of the income of every individual that makes more than X in the United States, and also the right to change your percentage as you went along? That's a very big number too. So you've got a very big asset there, and you've got some very big liabilities too. But the country is very solvent, and I would not like to see debt rise at any rapid rate. I wouldn't like to see it rise at all, but I wouldn't like to see it particularly rise at a rapid rate, because that sets a lot of things in motion if it's rising as a percentage of GDP. But if you tell me that 20 years from now the national debt will be $10 trillion, but that it'll be the same percentage of GDP, does that alarm me? Not in the least. I mean, so I expect it to increase, and I think there's some arguments why it may be advisable to have it increase, but I don't think it's a good idea to have it take up more and more of your income, because that sets a lot of other things in motion. So I welcome what's happened in the last couple of years, which is to see it decrease modestly from the trend that existed the previous 10 or 12 years. Charlie?
Well, generally, I think that you're right, that it isn't all bad, and to the extent that it is bad, a great nation with a capitalistic economy will stand quite a bit of abuse from the political side. It's a damn good thing, too, because I don't think we should be terribly discouraged. If there's anything that's really going to do the country in, it'll be what I call a Serpico effect, where you start rewarding what you don't want more of, and it then just grows and grows and grows. Yeah, but I don't think that's necessarily a bad fiscal result. It's just a bad result.
Berkshire owes $700 or $800 million or whatever it is now in debt, and then we have another $3 billion some afloat. But, those numbers would have sounded very big to me 25 years ago, and yet, we're one of the most conservatively financed operations you'll find. 10 years from now, we may owe more money, and it may be a smaller percentage still. I mean, you can't talk about debt levels without relating it to the ability to pay debt. And this country is probably in better financial shape now than it was in 1947. Zone one. But was there a second question I didn't answer on that? Or not? Oh, in terms of repurchasing shares, right.
No, you said, why don't we buy more?
Well, we think about it. But,
we did, not bought.
Yeah, we did. We bought more last year, and it's not a bad measuring stick against buying other things. But, I would not rule out Berkshire buying more. I don't have any plans to do it right now, but I wouldn't rule that out at all, because if I'm going to look at another business, I will say, why would I rather have this than more Coca-Cola?
Well, there he's saying something that is very useful to practically any investor when he said, use this as a measuring stick in terms of buying other things. For an ordinary individual, the best thing you have easily available is your measuring stick. If the new thing isn't better than what you already know as available that hasn't met your threshold, then that screens out, 99% of what you see, and it's an enormous thought conserver, and it is not taught in the business schools by and large.
No, and that's why we think it's slightly nuts when big institutions decide, because everybody else is doing it, to put 4% of their money in international equities or 3% in emerging growth country, some damn thing like that. I mean, the only reason to put the money in there is if they measured it against what they're already doing. And if they measured it against what they're already doing and they think it's a screamingly good idea to leave 97% in the other place and put 3% in, it just doesn't make any sense whatsoever. But it's what committees are talked to about and what keeps investment managers going to conferences and everything. So
they're deliberately using a technique that takes away the best mental tool they have. You can say this is nuts, and you're right. And I think Nietzsche said it pretty well when he said he laughed at the man who thought he could walk better because he had a lame leg. I mean, they literally are blinding themselves. And then they're teaching our children how to do this in our own business schools. Very interesting, don't you think? And what all Warren says is, deciding whether to do something, just compare the best opportunity you have. If that one is better and you're not taking it, why would you do this? Just because somebody tells you need 2% in international equities.
Zone 1.
Hi, my name is Mark Wheeler. I'm from Portland, Oregon. And I have a few eggs in your basket. My grandmother always said, don't put all your eggs in one basket. I have a question. I think you answered this a couple of years ago in one of your reports about Little Abner's investment approach. Suppose I had $100,000 and I decided to buy 4 or 5 more of your shares, and that was sort of a buy and hold thing for 4 or 5 years. And also I have a money manager. I've already got one, and he does pretty well, 10, 15%, but he churns the assets all the time. Every time I turn around, all this mailbox full of paperwork. I guess my question is, how can I arrive at which is a better deal for me? In other words, to buy Berkshire, which I like, and obviously I'm here, so I'm interested in it, or hang on to my money manager who just seems to be churning the hell out of the account.
Well, it's better than have a broker churn the hell out of the account. He's got a little less incentive if he's getting a management fee. But I can't answer your question as to which decision you should make in that case. But I would say that if you're right in the sense that if you buy Berkshire, you should only think about buying it for a very long period of time. I mean, we have no idea what Berkshire is going to do, either intrinsically or in the market, in the next year. And we care about the intrinsic part of it. We don't care about the market aspect. We do care about building intrinsic value. And in the end, we don't think, when we own Berkshire, we don't think of all our eggs being in one basket. I mean, because we have got a lot of good businesses. But if you're talking about some lightning from someplace, the huge liability suit or something like that hitting one corporate entity, we're one corporate entity. But if you think about it in terms of the business risk implicit in an entity, we have a lot of different good businesses. In fact, we probably have as decent a collection of good businesses as any company I can think of. But your money manager will also undoubtedly have the advantage of working probably with smaller sums too, and that gives him a bigger universe of opportunity. We're not set up tax-wise perfectly as compared to an individual working with their own capital. We're set up tax-wise fine for somebody who's going to sort of own it forever, but we're not set up capital. We're set up tax-wise fine for somebody who's going to sort of own it forever, but we're not set up.
Nothing to add.
Zone what? Oh, back there? I don't think it's on. Okay.
I'm Jeff Johnson. I'm grateful to be here from Tulsa, Oklahoma. I have two questions. First, I was hoping you could explain or offer an opinion as to why investors in property casualty insurance companies are willing to accept traditionally below average type of returns. Second question relates to an answer you gave me yesterday, that being that intuition or gut feeling has nothing to do in making investment decisions. I was wondering if there is anything subjective in yours and Mr. Munger's assessment of whether or not you like someone, and how it is that you determine whether or not you like the lord of the castle.
Well, I don't know, Charlie, do you want to answer that second part?
Well, we spoke about agency costs, and there are two different kinds of agency costs. One, the guy favors himself at the expense of the shareholders, and the other is he does foolish things, or he's not trying to favor himself, he just is foolish by nature. Either way, it's very costly to you as the shareholder. So you have to judge those two aspects of human character, and they're terribly important. And on the other hand, there are some good businesses so good that they'll easily stand a lot of folly in the managerial suite. And much as we like perfect people, I don't think we've always invested with them.
But generally, we like people who are candid. We can usually tell when somebody's dancing around something, or when the reports are essentially a little dishonest or biased or something. And it's just a lot easier to operate with people that are candid, and we like people that are smart. You know, and I don't mean geniuses, and we like people who are focused on the business. It's not real complicated, but we generally, there may be a whole bunch of people in the middle that we don't really have any feeling on one way or the other, and then we see some that we know we don't want to be associated with, and some that we know we very much enjoy being associated with.
Averaged out, we've been very fortunate.
Very lucky.
And your other question, you said, why is it that these investors accept below average results? Well, in the nature of things, approximately half the investors are going to get below average results. They didn't exactly accept it in advance, it's just the way it turned out.
And the money tends to be fairly captive once it's in a company. I mean, it takes a lot. If you have a business that gets subnormal returns over time, there's a big threshold in terms of either a takeover or proxy fight or something like that to unleash the capital. So money that's tied up in an unprofitable business or a sub-profitable business is likely to stay tied up for a good period of time. Eventually something will probably correct it, but capitalism does not operate so efficiently as to move capital around promptly when it's misallocated. We are in a better position to do that when Berkshire owns a company, and obviously we're in no position to do it because it involves something we don't want to do if we own it through some other enterprise. We just sell to somebody else who takes our chair at the table, in effect. Zone 3.
Hi, Philip King from San Francisco. I've got another question about valuation. More specifically, the relation of PEs to interest rates. I understand that you don't want to lay down a rigid formula for valuation, but I also know that you don't want people to think that a multiple of 20 times earnings is cheap or a multiple of 5 times earnings is expensive. So Benjamin Graham, he devised a central value theory that valued the average stock at an earnings yield that's about a third above bond yields. In other words, that would work out to maybe 11 times earnings currently. And I know that you've compared the average business to a 13% bond that's worth roughly book at 13% interest rates and worth perhaps roughly twice book at 6% interest rates. So given current interest rates of 7 to 8% as they are now, that would tend to imply that stocks are worth perhaps 12 to 13 times earnings. And yet the acquisitions that I've seen in the private market have gone out at more like 17 to 20 times earnings. And I'd like to know, what do you think is the rough range of multiples that makes sense?
Yeah, well, it isn't a multiple of today's earnings that is primarily determinant of things. We bought our Coca-Cola, for example, in 1988 and 89 on this stock at a price of $11 a share, which as low as 9, as high as 13, but it averaged about $11. And it'll earn, we'll say, most estimates are between 230 and 240 this year. So that's under 5 times this year's earnings, but it was a pretty good sized multiple back when we bought it. It's the future that counts. It's like what I wrote there, what Wayne Gretzky says, to go where the puck is going to be, not where it is. So the current multiple interacts with the reinvestment of capital and the rate at which that capital is invested to determine the attractiveness of something now. And we are affected in that valuation process to a considerable degree by interest rates, but not by whether they're 7.3 or 7.0 or 7.5. But I mean, we will be thinking much differently if their long-term rates are 11% or 5%. And but we don't have any magic multiples in mind. We're thinking we want to be in the business that 10 years from now is earning a whole lot more money than it is now, and that we will still feel good about the prospects of the business at that time. That's the kind of business we're trying to buy all of, and that's the kind of business that we try and buy part of. And then sometimes we buy others too. Charlie?
We don't do any of that rigid formulaic stuff.
There's a general framework that you can call a formula in our mind. There's a general framework that you can call a formula in our mind that we would actually calculation in terms of the equation. When we bought Coke in 88 and 89, we had this idea about what we thought the business would do over time, but we never reduced it to making a calculation. Maybe we should, but we don't think there's that kind of precision to it. We think it's the right way to think in a general way, and we think if you think that you can do it to pinpoint it, you're kidding yourself, and therefore we think that when we make a decision, there ought to be such a margin of safety that it ought to be so attractive that you don't have to carry it out to 3 decimal places. We'll take a couple more, and then we'll have to leave. We've got a directors meeting. We have one directors meeting a year, and we don't want to disappoint them. Zone 4.
Yes, I'm Roy Christian from Aptos, California. I wanted to ask one question about U.S. Air, which has not been questioned much at this meeting. When you were on television talking about the losses there, it was funny how so many of my friends or maybe acquaintances came forward to tell me this piece of startling news. And, I tried to stand up for you a little bit, and at least...
It was a mistake. You should have just taken a dive.
Well, at least I wanted to point out to them that you did have dividends over a period of about 5 or 6 years, and that money was reinvested maybe at a better return than U.S. Air, so that it wasn't quite the disaster that was pictured on television when you spoke about it, or the impression that all my friends, or I should call them acquaintances, pointed out to me. Just a comment, I guess, is what I'm asking for.
Yeah, well, you're right. It could have been worse, but it was a mistake. But we received 5 years, I guess, be 5 years of dividends at a good rate while we got it. But it's like somebody says, it isn't the return on principle that you care about; it's the return of principle. And but we're better off. We're a lot better off, obviously, than if we'd bought the common, and we're even better off than if we bought some other stocks. But it was still a big mistake on my part. But just keep standing up for me. I need all the help I can get on this one. Zone 5. Keep standing up for me. I need all the help I can get on this one. Zone 5.
Hi, I'm Chris Stavru from New York. Charlie, in addition to Warren, are there any books that you have been reading that you'd recommend? I know you're a fan of Bertrand Russell. Any favorite one or two of his books?
It's been a long time since I read those, though. I mean, I read a lot of Russell, but I did that a lot. He hasn't written much in the last 10 or 15 years. Charlie?
There's a textbook which is called, I think, Judgment in Managerial Decision Making. And it's used in some of the business schools, and it's actually quite a good book. It's not sprightly, it's not written in a sprightly way that makes it fun to read, but there's a lot of wisdom in it. It's something like Braverman, but it's Judgment in Managerial Decision Making.
Since taking up computer bridge, which is 10 hours a week, it's really screwed up my reading. It's a lot of fun, though. Zone 6, we'll take a couple more and then we'll...
Yes, I'm Dick Layton from Rockford, Illinois. This is the first annual meeting that I've attended, and it's been very beneficial to me. I've been extremely impressed with the number of people here, but even more so with the number of young people who have come. And I would like very much to be able to bring my grandchildren as shareholders, but I find it difficult to get shares into their hands with the current per unit value.
That's the nicest introduction to the stock split question we've had. It really is, too.
I thought you would appreciate that. Obviously, you understand the question. I understand the position you've taken over the years and the fact that it adds no value to make the split. In this case, however, it could be a tax savings to many of us who would like to get stock shares into the hands of other family members. Should I just go to work on my congressman to change the tax code, or would you consider a change?
Well, that's a very valid question, and there's certainly a couple of areas, one of which you've just mentioned, and I had someone else mention to me that, and there's certainly a couple of areas, one of which you've just mentioned, and I had someone else mention to me that it didn't work well in terms of using the Berkshire, although I think they could sell it and then pay out a percentage of it. But there are certain aspects, primarily of gifting, where it is anywhere from awkward to disadvantageous to have the price per share on a stock that exists with Berkshire. And, we're aware of it. We've thought about it. And we've got our own personal situations even sometimes that are involved in that. I've got one in the family that which we've figured out ways around. The disadvantage, of course, is that you saw a little even earlier this year of what a book can do. Or we want to attract shareholders who are as investment oriented as we can possibly obtain with as long-term horizons. And to some extent, the publicity about me is negative in that respect, because I know that if we had something that it was a lot easier for anybody with $500 to buy, that we would get an awful lot of people buying it who didn't have the faintest idea what they were doing, but heard the name bandied around in some way. And secondly, to the extent that ever created a market that was stronger, you then would have people buying it simply because it was going up. We got a little bit of that going on this year. There are a lot of people that are attracted to stocks that are going up. It doesn't attract us, but it attracts the rest of the world to some degree. So we are almost certain that we would get. We don't know the degree to which it would happen. We are almost certain we would get a shareholder base that would not have the level of sophistication and the synchronization of objectives with us that we have now. That is almost a cinch. And what we really don't need in Berkshire stock is more demand. I mean, that is not. We don't care to have it sell higher except as intrinsic value grows. Ideally, we would have the stock price exactly parallel the change in intrinsic value over time, because then everybody would be treated fairly among our shareholders. They would all gain just or lose as the company gained or lost over their ownership period. And anything that artificially stimulated the price in one period simply means that some other period shareholders are going to be disappointed. I mean, we don't want the stock to sell at twice intrinsic value or 50% above intrinsic value. We want the intrinsic value to grow a lot, but and I don't think there's any question but that we would get a worse result in that aspect if we introduce splits in, because then people would think about other possibilities that might give the stock a temporary boost. They had a tabulation in Business Week a couple of months ago on turnover on the exchange. They had a tabulation in Business Week a couple of months ago on turnover on the exchange. Well, those are people that are simply, they're shareholders leaving frequently and new shareholders coming in with shorter term anticipations. We have wanted this to be as much like a private partnership as we can have, with everybody having the ability to buy it. We don't think the minimum investment is too high in this investment world. I mean, there are all kinds of investment opportunities that are limited to $25,000 or $50,000 and that sort of thing. But the problem of making change, in terms of gifts, that I wish I had a better answer for, because I think that is
my grandchildren pay me the difference between $20,000 and the current price, and I think that's a very reasonable way for them to behave, particularly when they sometimes are only 6 weeks old.
Yeah. You need a spouse's consent to make it to work with 20, obviously, but most of the things can be solved, but I'll admit it isn't as easy to solve them as if we just had a stock denominated in lower dollars per share. I do think that once you get a shareholder base that has different objectives or expectations or anything, you can't get rid of it. I mean, you can keep a shareholder base like Berkshire, but you can't reconstruct it if you destroy it in some way. And it's important to us who we're in with. I mean, it enables us to I think it helps us in our operation. I think it even may, in some cases, it may even help us in acquisitions in terms of who we attract. For all I know, it may hurt us someplace too that I don't know about. But I don't think so, because I think we can design, particularly with a preferred stock, we can design something to satisfy somebody who might have in mind a different denomination security.
Look around you. Are we really likely to do a lot better? This is a good bunch.
That may be a good question to end on, and I appreciate it. I appreciate all of you coming, and we'll see you next year. Thank you.